One day you see Ashton Kutcher as Hollywood's funny man, pocketing $20 million an episode. Next, he is testifying before the U.S. Senate on child sex trafficking, and he has made $250 million from tech startups. How did a small-town kid from Iowa, who once offered his own heart to save his twin brother, outsmart Silicon Valley's elite and multiply $30 million into $250 million? The real story behind this transformation is almost never told. It begins long before his first tech win. Born on February 7, 1978 in Cedar Rapids, Iowa, Ashton Kutcher entered the world alongside his twin brother Michael. From the start, life delivered both boys a challenge. Michael was diagnosed with cerebral palsy and would soon face a life-threatening heart condition. At 13, Ashton stunned his family by telling doctors he wanted to give his own heart to save his brother. The offer was never forgotten. Friends and relatives describe Ashton as fiercely protective and willing to shoulder risk for the people he loved. Those early years shaped a sense of responsibility that would follow him far beyond Iowa. The Kutcher household was modest. Their parents, Larry and Diane, worked long hours to keep the family afloat. Money was always tight. Ashton picked up odd jobs, sweeping floors at a General Mills plant, washing dishes, even selling snacks at school to help out. He watched Michael endure surgeries and setbacks, learning firsthand how fragile security could be. The family's struggles left Ashton with a restless drive to change his circumstances, but also a deep empathy for anyone left behind. Everything changed in 1997. While walking through a local mall, Ashton was spotted by a talent scout and urged to enter a modeling competition. He won first place, left Iowa for New York, and signed with a top modeling agency. Within months, he was on a plane to Los Angeles, chasing a dream that felt out of reach for a small-town kid. Just 1 week after arriving, he landed the role of Michael Kelso on That 70s Show. The goofy, lovable Kelso made Ashton a household name almost overnight. The paycheck was life-changing, but so was the exposure to Hollywood's unpredictable rhythms. By 2003, Ashton was not just acting, he was producing. He launched Punk'd on MTV through his own company, Catalyst Media, proving he could spot trends and build brands. When 2.5 Men offered him $20 million per season from 2011 to 2015, Ashton hit the peak of TV earnings. But the numbers did not erase the lessons of his childhood. He knew the entertainment world could be fickle, and he wanted more than a fleeting moment in the spotlight. The search for lasting wealth and purpose had only just begun. A chance encounter in 2009 set Ashton Kutcher on a path few in Hollywood could imagine. At a Silicon Valley tech conference, he met Marc Andreessen, a venture capitalist already known for backing industry-changing companies. Andreessen did not offer a generic handshake or celebrity endorsement. Instead, he pointed Ashton to a deal on the table. Skype, the internet phone company, was raising money. He explained how technology could multiply capital at a speed and scale that dwarfed even the best Hollywood contracts. Kutcher listened. Within 48 hours, he was on the phone with Andreessen and his own business manager, reviewing term sheets and negotiating his first major tech investment. He put in a 7-figure sum. It was not a casual side bet. This was a leap into a world where fortunes could be made or lost in the blink of an eye. For 2 years, Skype's value climbed quietly. Then, in May 2011, Microsoft announced it would acquire Skype for $8.5 billion. Overnight, Kutcher's stake tripled. The return was immediate and dramatic, far eclipsing anything he had earned from a year of sitcoms or movie deals. The numbers spoke for themselves. A single investment, chosen with the right advice and timing, had generated more wealth in months than years of television stardom. This was not just luck. Kutcher saw that technology, unlike entertainment, could scale globally in an instant. A single product could reach hundreds of millions, and the right investment could turn a modest sum into generational wealth. He realized he needed a disciplined, systematic approach, a way to evaluate startups, leverage networks, and deploy capital with intention. The Skype deal became more than a financial win. It was proof that the future belonged to those who understood how technology would reshape everyday life. For Ashton Kutcher, it was the turning point that transformed curiosity into conviction and set the stage for the creation of a new kind of investment fund. A-Grade Investments opened its doors in 2010 with a clear-eyed approach to risk and reward. The founding partners brought together three distinct backgrounds: Ashton Kutcher, eager to apply his product instincts and network; Guy Oseary, a seasoned music manager known for spotting cultural trends and moving quickly; and Ron Burkle, the billionaire supermarket magnate providing both capital and business discipline. The initial pool was $10 million, $8 million from Burkle, $1 million each from Kutcher and Oseary. As word spread and their early deals gained traction, additional heavyweight investors like Mark Cuban and David Geffen joined, bringing the total capital base to $30 million by 2012. The partners agreed on a disciplined capital stack and an even split of decision-making power. Each deal required consensus, and early disagreements about management fees and veto rights were settled with a conservative structure. No one could push through a risky bet without the other's approval. Term sheets and investment memos, while kept private, reflected a balance between speed and caution. Oseary often pushed for rapid deployment, eager to catch the next wave before the crowd, while Kutcher insisted on hands-on due diligence, preferring to test products himself and speak directly with founders before writing a check. A-Grade's strategy in the early years was to write small checks, typically $50,000 to $100,000 per startup, focusing on consumer-facing technology that could scale quickly. As their reputation grew and the portfolio matured, check sizes increased, sometimes reaching into the millions of dollars for follow-on rounds. The team prioritized companies offering frictionless solutions and network effects, with Kutcher and Oseary leveraging their celebrity status to open doors and attract deal flow that most traditional funds could not access. Every investment was a calculated risk, grounded in the belief that disciplined partnership and direct product experience would separate them from the pack. This foundation set the stage for the blockbuster wins that would soon follow. Uber wasn't just a lucky break. It was the ultimate proof of concept for Ashton Kutcher's new approach to investing. In 2010, A-Grade put $500,000 into Uber, joining a syndicate led by Chris Sacca's lowercase capital. At the time, ride-hailing was a gamble. Taxis ruled the streets, and many doubted that strangers would trust an app to summon a ride. Kutcher did more than write a check. He became a regular Uber customer, testing the product and living the frustrations it solved. That first-hand conviction shaped his investment thesis. If a startup solved a real problem for him, it could do the same for millions. By 2016, that $500,000 Uber stake was worth over $60 million, a 100-fold return. Venture capitalists like Marc Andreessen called it a grand slam, noting that even a 5x return is rare in the industry. The win rippled through Silicon Valley, with insiders crediting Chris Sacca's syndicate for giving celebrity capital real teeth. Kutcher's diligence and willingness to use the product set him apart from the typical Hollywood investor. Airbnb delivered a second windfall. In 2011, A-Grade invested $2.5 million in the company, when short-term home rentals were still controversial and widely dismissed as a legal risk. Kutcher and Guy Oseary booked Airbnb listings themselves, grilling the founders about safety and customer experience before committing. Their bet paid off. By 2016, that stake had grown to nearly $90 million, a 36x return. These two wins were not just about big numbers. They validated Kutcher's approach of investing as a consumer, not just a financier. Celebrity access, paired with real product insight and hands-on testing, could outperform even the savviest institutional investors. Success in venture capital is rarely defined by a handful of headline wins. For every Uber or Airbnb, there are dozens of bets that quietly succeed or quietly fail. Within A-grade investments, Ashton Kutcher and his partners placed over 200 bets across the tech landscape. Out of that sprawling portfolio, fewer than 40 produced meaningful returns. But the math of venture capital does not depend on a high batting average. It depends on finding a few outliers and enough steady performers to make the risk worthwhile. Not every investment turned into a unicorn, but several companies delivered strong, measurable gains. A-grade stake in Spotify, for example, tripled in value, turning a $3 million investment into $9 million by 2016. Warby Parker, the online eyewear retailer, multiplied Kutcher's $300,000 to $2.1 million, a 7x return in just a few years. Houzz, the home renovation platform, saw a $15 million investment grow six-fold as the company expanded into new markets. These were not household names at the time, but they reflected a pattern: disciplined bets on products that solved real problems, backed by teams with the grit to scale. By 2013, the cumulative value of A-grade's portfolio crossed $100 million, a milestone that drew attention from both Wall Street and Silicon Valley. The sheer number of companies, over 200, meant that losses were common and often expected. Kutcher described the failures as tuition, the price of learning in a field where black swan winners pay for everything else. The spread of returns, from modest triples to total write-offs, painted a realistic picture of the risk profile. This breadth and depth set the stage for independent analysts to scrutinize A-grade's results, seeking proof that the fund's success was more than just luck with a few big names. In practice, the numbers showed a portfolio built around a handful of outsized winners and a larger base of steady performers that together produced substantial returns. Forbes set out to verify the numbers behind A-grade investments. In March 2016, reporter Carrie Dolan conducted a deep audit of the fund's records, cross-checking exit values, current portfolio marks, and investor statements. The results were hard to ignore. A-grade's $30 million in starting capital had grown to $250 million in just 6 years. That 8.5x multiple was not just rare for a celebrity-backed fund. It outperformed the vast majority of professional venture capital firms. Marc Andreessen, a benchmark for the industry, once said that a 3x return is considered excellent, and 5x is a home run. Kutcher's fund, by comparison, stood in a league of its own. The audit did not just focus on headline wins like Uber and Airbnb. Forbes analysts and outside venture capital experts reviewed the rest of the portfolio, looking for signs of overstatement or luck. Even with Uber and Airbnb removed, A-grade's remaining investments still delivered strong results. Industry analysts estimated the portfolio would have returned well above the average for early-stage funds, with a multiple that placed it among the top performers in Silicon Valley. The discipline of spreading bets across more than 200 companies, rather than chasing a single unicorn, proved its worth. Out of those, fewer than 40 produced meaningful returns, but the magnitude of the winners far outweighed the losses. Forbes published its findings in what became the magazine's most read story in nearly a century. The article did not just give Kutcher's team a victory lap. It set a new benchmark for what celebrity investors could achieve. The numbers, independently verified, quieted skeptics and drew the attention of institutional investors. The audit also made clear that A-grade's success was not a fluke tied to a single lucky break. Instead, it was the product of disciplined selection, relentless networking, and a willingness to bet on the future before the rest of the market caught on. Sound Ventures launched in 2015 with a $100 million commitment from Liberty Media, setting the stage for Ashton Kutcher's next act as a serious force in Silicon Valley. No longer limited by the modest capital of his early days, Kutcher and Guy Ociari began writing checks that ranged from $100,000 to $10 million, targeting everything from financial technology disruptors to global logistics. By 2023, Sound Ventures managed over $1 billion in assets, confirmed by both SEC filings and industry analysts. The portfolio stretched across more than 100 companies, including Robinhood, Brex, Affirm, Lemonade, Airtable, Flexport, and Bird. Each investment reflected a sharpened strategy, fewer bets, but deeper conviction, and a willingness to back companies that could reshape entire industries. The pace accelerated with the rise of artificial intelligence. In May 2023, Sound Ventures closed a $243 million artificial intelligence-focused fund in just 5 weeks, an unprecedented fundraising sprint for a venture firm not backed by a major bank. The plan was bold. Concentrate $35 to $50 million in only 6 companies, including OpenAI, Anthropic, Stability AI, and Hugging Face, each at the cutting edge of machine learning. The move signaled a new phase. Kutcher was no longer just following trends, but placing outsized bets on the technologies he believed would define the next decade. While Sound Ventures scaled up, Kutcher's commitment to technology with a conscience found its clearest expression in Thorn. Co-founded in 2009, Thorn develops artificial intelligence tools that help law enforcement identify and rescue child trafficking victims. Its Spotlight software has been credited with finding over 27,000 exploited children and removing more than 2 million abusive images from the internet by 2023. Kutcher's testimony before the United States Senate in 2017 captured the gravity of this work, as he described the harrowing reality of building technology to fight real-world evil. Thorn's approach, deploying advanced algorithms to scan millions of online ads and dark web posts, reflects the same belief that software, at scale, can solve problems once thought impossible. Privacy advocates have voiced concerns about automated surveillance, but law enforcement and survivor groups point to shorter rescue times and thousands of lives changed. For Kutcher, the lessons of his childhood, protecting the vulnerable, using every tool at his disposal, have become a blueprint for action, both in business and in the fight against exploitation. Venture capital now shapes how technology touches our lives and who gets left behind. As celebrity investors pour billions into startups, the line between fame and financial influence blurs. Kutcher's playbook is fueling a wave of new power brokers in Silicon Valley. The next breakthrough, or the next blind spot, may depend on who holds the checkbook and what future they choose to build.